Welcome to the deep dive. Today we're putting Ugro Capital right under the microscope. And this isn't just a quick review, it's a detailed fundamental analysis really designed for you, the investor, who's focused on that structural growth story in India's NBFC sector.
That's right. Ugro is positioning itself as a high-growth player, maybe even a disruptor, in MSME financing. Our mission today is to go past the headlines, really dissect their Q2 FY26 results, understand the tech behind their strategy, and I think most importantly, assess the trade-offs they're making between that aggressive growth and their profitability.
Okay, so let's start at the very foundation. We hear about the MSME credit gap all the time, but how exactly is Ugro carving out its niche here? What's the real size of the opportunity they're chasing?
Well, the context is just staggering. The total MSME credit gap in India is conservatively put at INR 1,003,000 billion. It's monumental.
A huge number.
It's huge. And Ugro isn't trying to boil the ocean here.
Mm.
They're focused on a very specific underserved middle layer. Think enterprises with an annual turnover of maybe INR 25 lakhs up to about 15 crores.
Right. The sweet spot where demand is high, but formal banking is, well, historically low.
Exactly.
So they see the gap. But how do they structure their products to manage the risk? We all know MSME lending can be incredibly volatile.
They do it through diversification and security. Their portfolio has multiple risk layers built in. You've got the secure backbone, which is their secured business loans. Average ticket size there is about 89 lakhs, and it yields a decent 14.0%.
Okay.
Then there's the emerging market loan against property, or LAP. Smaller tickets, around 17 lakhs, but the yield is higher at 18.7%.
And I'm looking here at the embedded finance segment, the MSL platform. It's listed with a yield of 26.0%. That is a massive number. But a yield that high, it always screams high risk, doesn't it?
You're absolutely right to question that. That 26.0% yield comes from very small, granular ticket sizes, averaging just 1 lakh rupee. It's a high-volume, high-yield digital play.
So it's unsecured.
It is. But crucially, they manage that overall risk by keeping the total portfolio around 70% secured. That provides a really significant buffer compared to, the pure-play unsecured NBFCs.
Okay, that 70% secured book is a key defense. But in the long run, what stops a major bank or a competitor from just moving into that same sweet spot? Where's Ugro's actual advantage, their moat?
Their moat is purely technological. It all centers on their proprietary underwriting system, the GRO Score 3.0. And it's not just some fancy algorithm. It's specifically designed to solve the information asymmetry problem with MSMEs.
How does it do that?
It uses what they call the data tripod. So instead of just relying on traditional bureau data, the model integrates 3 data streams: bureau, banking transaction data, and most importantly, GST data.
Ah, the GST data is the key.
It is. For an unserved customer, that GST filing history gives Ugro a verifiable, almost real-time view of their business health and cash flow. It's something legacy lenders just haven't incorporated that efficiently yet. That holistic view is their edge. It lets them underwrite customers that others would just deem too risky or opaque.
That makes perfect sense. Access to structured digital data is how you unlock the real cash flow of these small businesses. And how are they deploying this on the ground?
It's a multi-channel approach. They have their prime intermediated channel in metros and Tier 1 and 2 cities. But the really aggressive push has been their emerging market network. As of September 2025, they had 325 physical branches expanding deep into the hinterland. And that physical presence is then synergized with the high-volume, low-cost digital acquisition through their embedded finance platform.
Let's move to the performance report then, the income statement. For a financial company, the P&L structure can be tricky. Before we get into the numbers, what metrics are we really prioritizing here?
For lending, the real story is PPOP, or pre-provisioning operating profit. PPOP is your operational profit before you deduct the critical variable of credit provisions. You could compare it to EBITDA, but for an NBFC, PPOP is just a superior metric. It shows core operational efficiency before you account for the risk costs. And then, of course, we look at PAT, profit after tax, the final bottom line.
Right. So looking at Q2 FY26, what's the top line telling us?
The top line shows very robust growth. Total income grew 35% year-on-year to 461.2 crores. But, and this is where the cost structure challenge comes in, net total income, so what's left after finance costs, grew at a slower 21% to 242.6 crores.
So that gap signals the drag from their cost of funding.
Exactly. It immediately highlights one of the major trade-offs we need to dig into.
But what about operational efficiency? Did they manage to improve the net total income margin?
They did, but only slightly on a sequential basis. The margin was 13.9% of average AUM in Q2, which is up from 13.2% the quarter before. So this modest increase suggests either better asset yields or maybe some slightly optimized OpEx coming through.
And the final take-home for shareholders, the PAT. What did that look like?
PK showed notable resilience. It came in at 43.3 crores. That's a 22% increase year on year, but maybe more importantly, a strong 27% recovery quarter on quarter.
So bounce back from Q1.
Yes. Management noted Q1 is often a bit softer, so this sequential jump really indicates they've stabilized and are back on a solid growth path after that seasonal dip.
And what about the cost of that growth? Are provisions under control, especially with all the market stress we're hearing about in small-ticket unsecured loans?
They're maintaining discipline. The credit cost for Q2 FY26 was 44.3 crores. But what's exceptional here is that this provisioning expense was identical to the credit cost in Q2 of the previous year.
Identical.
To the decimal. And that stable credit cost, despite a 35% growth in income, signals that the GRO Score 3.0 system is delivering predictable and contained losses, even with the market risks.
We've established they're generating profit. Now we have to pivot to the bedrock of any financial institution, the balance sheet. How solid is that foundation as of September 2025?
Structurally, the balance sheet looks robust. Their capital adequacy ratio, CRAR, is very healthy at 25.4%, well above what's required. Their net worth is strong at 2,463 crores.
What about leverage? They're growing fast. That needs capital. How far are they stretched?
Their leverage, so debt to equity, is at 3.3x. This is comfortably below the regulatory limits, and it gives them significant headroom to absorb the capital needed for their aggressive AUM target of 20,000 crores. They're capitalized for growth.
Let's talk about cash flow quality. Profit on the P&L is one thing, but for a lender, cash collection is everything. Are they actually seeing that profit in the bank?
This is where their underwriting success really shines. We don't always get the full operating cash flow breakdown in their presentations, but we can rely on a critical proxy, collection efficiency. In Q2 FY26, their total collection efficiency improved significantly to 100%.
Wait, 100% collection efficiency. In the MSME segment, that's notorious for cash flow hiccups. That sounds less like a financial metric and more like a huge operational achievement.
It is a profound indicator. Achieving 100% collection efficiency, meaning they're collecting all of their dues on time, it suggests their GRO Score 3.0 system is excellent at segmenting borrowers who have strong payment discipline. It's a strong validation of their whole asset generation process.
And what does this translate to in terms of asset quality risk? What are the NPA numbers?
Asset quality is stable and manageable. Gross NPAs are at 2.4% of AUM, and net NPAs are at 1.5%. Management says this is well within their internal estimates, which is a key checkpoint for investors when a company is growing this aggressively.
Now for the acid test. We've confirmed the growth, the healthy assets, the strong capitalization. But how efficiently is UGRO actually deploying all this capital to generate returns for its shareholders? Let's dive into ROE and ROC.
Right. So return on equity, or ROE, measures the profit for every rupee of shareholder capital. And return on capital employed, ROCE, is broader. It shows profitability from all capital, both equity and debt.
And the data shows the trailing 12 months ROE is, well, it's low, around 8%, 8.26% for FY25, and ROC is 11.0%. For a high-growth NBFC, these numbers are a major point of contention for investors. Why so low?
This is the absolute core of the UGRO investment thesis, and management is quite transparent about it. The low current ROE isn't from poor lending. It's a direct consequence of bearing heavy upfront operational expenses from their expansion.
The 325 new branches.
Exactly. Think of it as investing heavily in physical infrastructure before those branches have matured enough to even cover their own fixed costs.
So it's a bet on operational leverage kicking in later, but that is a big assumption. What's the explicit guidance from management that gives investors any confidence this will reverse?
Their stated goal is a structural leap in profitability. They're targeting a 4% return on assets and a significantly improved ROE within the next 6 to 8 quarters. And they've tied this target directly to branch productivity. The model assumes that once those 325 new branches reach a steady state, which they define as 1.1 crore disbursement per month per branch, the operational leverage will just drastically cut the cost-to-income ratio and drive the ROE up.
That's a high bar. A 4% ROA is phenomenal for the sector. An investor buying UGRO today is essentially betting on management's ability to execute that high-leverage branch maturation strategy flawlessly over the next 2 years.
Exactly. And to speed that up, they have two main strategies. First is inorganic growth. The proposed 1,400 crore acquisition of Profectus Capital, that immediately adds over 3,400 crores of AUM.
which accelerates their 20,000 crore goal.
It does, and it also strengthens their secured book and adds expertise in niche areas like school finance.
And the second lever is maximizing that high-yield digital side we talked about.
Yes. The embedded finance platform MSL is crucial here. It crossed 12,270 crores in AUM by September. This segment, with its 26.0% yield, acts as a high-margin booster. They're targeting it to be 10 to 12% of the total AUM, and that will be key to lifting the blended portfolio yield to hit that 4% ROA target.
Okay, let's talk about a critical risk management move. Management made a strategic call to slow down growth in certain areas. Why hit the brakes in a high-growth sector?
This is a really nuanced move that signals maturity, I think. They intentionally cut organic disbursement in the first half of FY26 and tightened their underwriting filters, slashing throughput from 30% down to 20%, specifically in unsecured loans.
And why did they do that?
It was a direct response to internal stress signals they were seeing in the small-ticket unsecured market. But it was also about the explicit need to manage their high cost of borrowing, which stood at 10.37% in Q2.
That high borrowing cost seems like the most glaring red flag here. At 10.37%, they're paying 150 to 200 basis points more than a lot of established peers. Isn't that an unacceptable structural disadvantage? Doesn't it just cap their profitability no matter how good their tech moat is?
It is arguably their biggest near-term headwind. That differential expense directly eats into their net total income. That's why management is willing to go through the pain of slowing down disbursement. The goal of this tactical slowdown is to reduce their overall borrowing need, improve their credit profile with funders, and eventually narrow that 150-200 basis point gap.
They're also dealing with regulatory change. What's the story with the new RBI co-lending guidelines coming in January 2026?
That's a long-term positive. The new guidelines bring all co-lending under a formal regulatory umbrella. And most critically, they allow for a first loss default guarantee, or FLDG, up to 5%.
And that helps how?
That formalized risk cushion just significantly reduces the risk for their bank partners. It makes UGRO's assets much more attractive for co-lending, which should, in theory, increase their volumes and reduce their blended cost of funds over time.
So we've hit the borrowing cost. What are the other explicit red flags an investor should be flagging?
Well, beyond the cost of funding and the stress in the unsecured book, there is a governance flag. Promoter holding is extremely low at 1.88%. Right. And while the company is largely institutionally owned with strong governance standards, traditional investors often see such a low promoter stake as a major area for concern, a lack of skin in the game.
So to bring this all together, Ugro Capital presents a compelling, if complex story. Let's synthesize the analysis. What are the three biggest positives for the investment case?
First, strategic clarity and market focus. They are surgically focused on that massive INR 1,003,000 billion MSME credit gap. They have clear product segmentation, and they're executing with purpose.
Okay.
Second, the tech moat and asset quality. Their proprietary GRO score 3.0, validated by that data tripod, is delivering real results. You see it in the stable GNPA of 2.4% and that exceptional 100% collection efficiency.
Right, the data's proving out.
And third, future ROA levers. They have a credible, articulated path to structural profitability. It's through the operational leverage from branch maturity and that high-yield kicker from the 26% yielding embedded finance segment. They are targeting that coveted 4% ROA.
And on the flip side, what are the three most significant negatives or risks that must be monitored?
First, the high funding cost headwind. That current 10.37% cost of borrowing is 150-200 basis points above peers. It's fundamentally compressing their margins right now and preventing any immediate ROE expansion. Second, the trade-off on risk and growth. The need to strategically cut back on unsecured lending shows the sensitivity of their high-yield book to market stress. It confirms the inherent risk. And third, the operational maturity drag. That current low ROE is a direct result of the operational expense drag they're absorbing now. It's the cost of building that 325 branch network, which won't pay off until productivity hits their target.
What's fascinating here is the core management decision. Ugro is making a very calculated trade-off. They're choosing to temporarily slow down volume and absorb the cost of a huge network build-out, all to ensure that future growth is built on a better foundation of asset quality and hopefully lower funding costs. It's quality over pure raw quantity for the next few quarters.
And this raises the final critical question for you to really mull over. How much weight should an investor truly assign to the intangible data moat? the power of that GRO Score 3.0 platform versus the very tangible, very immediate headwind of that 10.37% borrowing cost and figuring out the timeline and likelihood of them achieving that ambitious 4% ROA target.
Food for thought indeed. Thank you for diving deep with us into Ugro Capital today. We'll catch you next time.